Our next guest for today, joining me, Sandeep Bagla, CEO of Trust Mutual Fund. Sandeep, lovely chatting with you as always. The markets have been fairly ranged, right? 24,500 to 25,000. How have you really been approaching, this ranged market? Are you rotating out of certain sectors and getting into some? How are you approaching? Because if you look at the FII flows for May, they were fairly good. I think 20,000 crore rupees or thereabouts. That was the best for 2025. But once again, they are turning sellers. They were sellers for a second straight day yesterday, and there are renewed trade tensions as well between US and China. How is the setup looking like for us?
Good morning, Anita. Always a pleasure to be on your show. So you are right. Markets are fairly range bound in a narrow range, I would say. The way to approach the market is that, while earnings are just about as per expectations, and flows are also a little iffy in terms of the FPI flows. So I would think that the markets are in a wait and watch mode, waiting for more data to emerge. There are factors which are supportive besides the resilient Indian economy. There are factors on the macroeconomic side which are positive in nature. RBI has cut rates, improved liquidity, credit offtake is yet to really pick up. However, what has happened positive is that government capex has been very high, both in the months of March and April. I am told that in March they spent about 2.4 lakh crores, which is the same number as FY18. And in April also they had spent almost close to 1.4 lakh crores. So, the impact of the government capital expenditure will show with a lag, and which is why there are opportunities probably in the capital goods segment, in the industrials, in the financials, and at the same time, the uncertainties and the risks are also building up. So you have on the Trump tariff side there are uncertainties, the fact that demand is a little sluggish, and we don't know how long it will take for the growth to pick up and earnings to show up in company numbers adds to another element of uncertainty. So I would say we are on an even keel, which is probably why markets are not really able to make a breakout on either side. And it is perhaps a time for the expert fund managers to step in, and there can be a fair amount of churning in portfolios, positioning for the events to come through in the maybe in the next 3 to 6 months.
So, what are your top conviction ideas within the domestic capex or services space? Since you are saying, of course, that government spending has picked up and it will, flow through or show up in a lagged, with a lag effect. So, any within the basket, the capex basket, any top conviction ideas in terms of sectors? Of course, you won't get into
So
stocks.
yeah, so there would be, I would think that, certain sectors are likely to show up better. Uh, Companies in the infrastructure, capital goods segment, like, power transmission, they are companies which are not leveraged, where the ROE is good and where the numbers are also showing up. I think these are the, so-called low-hanging fruits. And, certain companies in the banking segment, especially the capital market segment, I think the stocks have done quite well. And the stocks in the capital market segment, like asset management companies, broking companies, your depository, AMCs, wealth managers, these companies which are linked to capital markets all tend to do well together, stock exchanges. So I think these are the segments which are looking slightly more attractive with the immediate growth. I mean, other companies, it might take some time for growth to materialize, but there are certain segments within the infrastructure capital goods segment, within the financial markets, which are doing fairly, they have greater visibility of earnings in the short run. And hence, markets tends to reward them at a quicker pace at times when uncertainty is high. So I would say domestically focused companies, and within that, capital markets and capital goods.
Okay, capital markets and capital goods, two overarching themes. But tell me, with the recent GDP data and inflation at sub 4% levels, well within the RBI's comfort zone, how many rate cuts are you penciling in for FY26? And talking about Friday in particular, looking at the recent data, what are the chances of a jumbo 50 basis point rate cut? Because the consensus is that the RBI will go in for a 25 basis points. Is there an outside chance that we can see a jumbo 50 basis point rate cut as well?
See, there was an outside chance because given the clarity of thought and mission with the current RBI governor, it seemed very clear to everybody that monetary conditions would be eased. And but I think the GDP growth number has been higher than expected, and probably that will put a brake on any expectations that there would be a 50 basis points rate cut. I think, just like in mutual funds, we recommend that you do an SIP. I think RBI is also going to cut rates in 25 basis point lots at this moment. We are expecting 50 to 75 basis points rate cuts, but there are extremes in the market. I have seen seasoned economists talk about 100 basis points rate cuts also. Uh, we believe that 50 to 75 basis points is, quite possible in the next 3 months. So on Friday,
Oh,
definitely 25 basis points rate cut
okay, 50.
with a benign guidance. Uh,
Sure.
that seems course for the path.
Okay. Let's talk about some other pockets as well. For instance, the real estate space. How would you really approach this space? Would you look at it, from the luxury lens? Would that be a long-term story, or would you look at affordable housing? Where would you find more headroom for growth when you look at the real estate space?
Yeah, I think that if monetary conditions continue to be conducive and growth is between 6 to 7%, real estate is a continuing success story in India, both at the affordable housing and at the luxury real estate bucket also. Stocks would have done well in the past, and I think I mean, at the portfolio level, at least I can see that we have stayed clear of the real estate factors. But I think there is steady growth. Maybe you are not going to see a bumper pickup anytime soon because the economy is sluggish. There is uncertainty, and people tend to postpone their large decisions, financial decisions in times of uncertainty. So I think it is likely to be steady, but not spectacular.
Okay, that's the view. Let's talk about the recent IPOs as well, right? Didn't really see a lot of appetite, for some of the recent names. What do you think is leading to, muted appetite for IPOs? Is it the valuations that's, a cause of worry? Because, recently we had Hotel Leela as well. A lot of experts are bullish on the hotels theme, but here, do you think valuations were a concern, given the fact that the leader of the pack, Indian Hotels, is available at a much cheaper valuation? Because business for Hotel Leela is pretty strong. Something went wrong there. And what about the gush of IPOs that is expected to hit the Lal Street? Do you think appetite will pick up? What are your thoughts on this, on the primary market action?
Yeah, I think the appetite will pick up. We must understand, Anita, that we are coming from a phase when the equity markets have delivered extremely high returns. And I think this is a phase of consolidation and wait and watch mode where we will wait for more data to emerge. It is understandable that the amount of money which had flooded the equity markets has taken somewhat of a breather because it is not immediate returns that we are looking out. Probably, I've said this in the past also, that time for T20 is over, and probably today is the finals. So now definitely T20 is over, and probably the time for the longer format investing is there. And I think people have to temper their expectations. I think this adjustment phase, I think IPO markets will continue to flourish. because India is opening up, companies are gaining in size and are looking to expand, and capital market appetite is there. I think one should look beyond, just short-term performance, which is, listing gains and things like that, which actually don't make that much of a sense in a mature market. And I think also some of these companies that you were mentioning, like hotels, the immediate earnings cycle might not see an immediate revival. It might take its longer term bet. So I think longer term investors would be a little more patient and they might not be in a hurry for immediate gains. So I think there will be interest, investor interest in these companies, in these stocks, in this sector, but with a patient investor.
Okay, that's the view then on the hotel space. Be patient, with some of the stocks in this sector. Well, last question really. You guys follow a philosophy of guerrilla investing, right? Focusing on rare market leaders with strong moats and lasting dominance. From your experience as a CEO, how would you define the concept of guerrilla investing, and what are the specific signs or indicators that investors should look out for when identifying these guerrilla companies early, especially those with potential to sustain and outperform over decades? Share your thoughts and how you guys really, follow this philosophy.
This is a sort of a North Star for us where, we try to follow it. And the idea is to identify companies which are long-term compounders and are adding value to their customers and investors also. But at the same time, Nanita, it is not an easy thing to do. Mr. Warren Buffett had said once that, everybody believes that, they can become Warren Buffett. It is the fund manager's job. It's a specialized job, and they are working 24/7, trying to identify gorilla stocks. This is an aspirational thing in nature. It's aspirational in nature. It's not that you can find gorilla stocks easily. We live in a fairly complex world, which is very intensely competitive, and things keep changing all the time. So we look at themes like mega trends. So we believe, for example, that capital markets is a theme which will continue for a long time. People who are investing in FDs, fixed deposits, are now willing to invest in India's future and take the equity risk. That is a theme which will continue. So we look at mega trends. We look at leadership very closely. That if there's an opportunity, there's a mega trend, which are the companies which have leadership, which can take full benefit of the mega trend in progress. And also we look at something that we call intangible assets, which are basically, if you look at the companies globally who are commanding high valuations, they don't necessarily have a very high number of assets. They have what we call intangible assets, a brand, a customer service, customer orientation, technology platform. Companies, the biggest companies today probably do not have their own manufacturing units also. So we also keep an eye towards what kind of intangible assets the company is gathering. That gives us a better idea about who's likely to survive, who's likely to thrive in the long term. Again, a word of caution, this is a specialized full-time job. So best to stay with seasoned fund managers who are managing mutual fund schemes at a very tiny cost. Stay with the mutual fund schemes and try to identify gorillas at your own risk with a small amount of money.
Sure, point taken. That's the way you go about when it comes to guerrilla investing, spotting companies with good long-term potential. With that, Sandeep would like to thank you for taking out time and joining in this morning. Always a pleasure. Look forward to connecting again sometime soon.
Thank you, Nandita. See you soon.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.